Hi everyone, I hope you can hear me. Thank you for joining us for today's webinar, where we'll be introducing you to the Climate Bond's Marine Renewable Energy Criteria developed for the Climate Bond Standard and Certification Scheme. Anna Creed, Head of Standards here at Climate Bonds, and Christine Negra, the Lead Specialist for the Marine Technical Working Group, are here today to talk you through these criteria. But before we begin, I'd just like to go over some basic housekeeping. This webinar will run for 1 hour. We will have a dedicated Q&A session at the end of the presentation. At the moment, your microphones are muted, but you can submit questions at any point during the webinar by using the Q&A panel in the webinar platform. It's just on the bottom right of your screen. If you're phoning in, you can submit questions by emailing them to katie@climatebonds.net. That's katie@climatebonds.net. This webinar is being recorded and will be made available to participants of the webinar, and it will be on our YouTube channel shortly. We'll email you with the links. Now, over to Anna to kick us off.
Thank you, Katie, and good afternoon or good morning, everybody. As Katie said, we're really glad you could join us for the call today. The agenda for the webinar is I'll just give a brief introduction to the Climate Bonds Initiative and then the Green Bond market and what we're trying to do with our work on the Climate Bond Standard and specifically with the Marine Renewables Criteria. And then I'm going to hand over to our lead expert on the marine work, Christine, who is going to talk you through some of the issues that were discussed in the process of developing these criteria and how that's influenced our decision making over these draft criteria. And then we'll give you a summary of what the criteria actually are. And then, as Katie said, we want to open the floor to any questions that you have. And I would also like to stress as well that this webinar is part of the public consultation on these criteria. So we're very happy to receive any questions and feedback on the webinar today. But also, if you have any more detailed questions or feedback that you would like to submit after the webinar, please do reach out to us via email or via our website. The purpose is really to gather everybody's thoughts and make these criteria as effective as they can be. So all input is very much welcome. So many thanks for joining us today as the start of that process. Okay, so first up, in terms of the Climate Bonds Initiative and what we do, just a brief introduction here. We are an investor-focused not-for-profit organisation. We are based in London, but we now have a number of staff around the world, including in India, in China, in Brazil. We have a representative who covers a number of African countries. We're very much a global initiative looking to mobilise debt capital markets globally for climate solutions and make sure that we can get investment funds moving from brown to green investment so that we're all moving towards the necessary transition path to a 2-degree, 1.5-degree world where we are resilient and adaptive to climate change. And the way that we try and do this, we've got 3 main strands of work. One is we do a lot of outreach to inform and stimulate the bond market. We do a lot of policy work. We work with governments around green investment pipelines and green finance capital raising plans. We also do a lot of work on that in developing countries particularly, hence the countries I mentioned like India, Brazil, China, Nigeria at the moment as well. We really see this as a need for a global transition, and so we will work in whatever country that are moving in this sector that we want to support them to do so. We're also trying to look at a lot of new innovations in the green space, including securitization and covered bonds, Islamic finance, as well as your mainstream bonds as well. So we're quite broad in the types of instruments and financial instruments that we're working with. As well as that kind of outreach and engagement, we do a lot of market analysis of the green bond market itself. We track green bonds that are issued. We give an informal view on our view on how green they actually are based on the use of proceeds of those bonds. Every year we do a state of the market report which summarises the picture of green bonds that have been issued in the last year, and we also have a blog that you can sign up to if you're interested in this, where we do give very regular updates on bonds that have been issued or other trends or other movements that are going on in the green bond market. And then lastly, but not least, we have the Climate Bond Standard and Certification Scheme. I'll talk a little bit about this later because this is really where the criteria fit in. But in essence, what it is a set of definitions for investors and guidelines for bond issuers. And it's a certification scheme so that we can ensure that there is credibility in the green bond market, that there isn't greenwashing, that there are a set of standards that green bonds are being assessed and evaluated against. That's the purpose of it as an overview. And then as a bit of background to the green bond market itself, on the next slide, we basically have this bar chart shows the growth in the green bond market since the very first green bonds were issued, actually back in 2007, from the Development Bank, the EIB and the World Bank issued green bonds back in 2007. And you can see we really started taking off around about 2014. Still, there's strong engagement from the development banks, but that's when corporates really got involved in the green bond space. And in 2016, we took another big jump up, and that's where we really saw China engage in the green bond market, and they were responsible for about a third of green bonds issued globally last year, so a very big impact on the market when China joined. In essence, we're expecting around about perhaps 130 billion of green bonds to be issued this year, this calendar year. And just in a summary, what makes a green bond and not a regular bond is it's linked to the use of proceeds of the bond. So the proceeds are going to green assets and projects. There is a requirement around transparency and reporting within that. So you will often see that in green bonds as well. And that's another reason why they're attractive to investors, partly because of the green credentials of them, and partly because it does bring another degree of transparency about the use of proceeds of the bond and the reporting associated with that. Bonds are often used to refinance existing assets and projects, but they can also be used to finance new greenfield sites and projects as well. The benefits for investors are really that they can engage in addressing the climate risk, and these bonds are increasingly having impacts in terms of secondary market value. And it benefits for issuers of green bonds, essentially that they can attract, we're seeing that they can attract a more diverse set of investors. People that have issued green bonds have attracted new investors they haven't necessarily been able to engage with before, who were interested in the green label and the green use of proceeds of that bond. And that in turn enables them to set themselves into a positive market positioning around their credentials in this space. Okay, then the next slide is a summary of the Climate Bond Standard and Certification Scheme. And like I said, it's a fair trade like labelling scheme for bond. It's really designed as an easy-to-use tool for both investors and issuers, that they can prioritise investments that truly contribute to addressing climate change. And that's because there are kind of two parts to it. One is the Climate Bond Standard version 2.1, and that covers the requirements that all certified bonds need to meet, and that addresses issues around transparency of use of proceeds, management of use of proceeds, and disclosure information. And then there are also, alongside that, a set of sector-specific criteria, and those criteria detail, in a sense, they're the green credentials of the bond. We work sector by sector because the green credentials and the green requirements are very different for transport assets compared to building, compared to marine renewables. And in this way, it enables us to ensure that we're setting robust scientific criteria that are relevant to that sector of the economy. And those two parts together basically make up the Climate Bond Standard. And as I've said, what's really critical here is that what we're trying to do is set criteria and definitions and thresholds here that make sure that the assets and the bonds that we're certifying are aligning with this 2-degree pathway, and are also supporting a transition to a resilient and adaptable economy. On the next slide, just to give you an illustration of the scope of that work then, is what we call the Climate Bonds Taxonomy. This might be a little bit difficult to see, but essentially all of these boxes indicate a sector or a subsector of the economy where we are looking to develop green definitions and green criteria that we can assess against for the purposes of certification. The boxes with a blue circle in them mean that we already have criteria and they're released and available for the market already. And that includes, in the energy space, solar and wind and geothermal assets. In the transport space, it includes rail, land vehicles, buses, cycling, all those kind of assets. In buildings, we have criteria for commercial and residential buildings, and we're also looking to include things like hotels and retail spaces as well. And another set of criteria we included recently were water infrastructure assets. And then the ones with the yellow circles are where we are currently developing criteria, and that includes what we're going to talk about today. So that's circled here. And it's the marine renewables set of criteria, and we'll talk more about what that covers in a minute. We're also working on further criteria in the marine space, which includes fisheries and aquaculture, coastal infrastructure, and also shipping and ports. And then we are also looking at land use, so agriculture, forestry, other land-based activities. We're doing work on waste management. We're doing work on hydropower and bioenergy as well. So there's quite a lot of activities going on, and we hope to bring all these criteria to the market in the coming months, over the next sort of 3 to 6 months. They're at various stages of development. And then all of these other boxes on here with the little grey circle are areas that we will move to late this year, early next year. And these include a lot of industrial energy efficiency, information communication and technology, and various other sectors. And I guess the key point here is we need to work through all sectors of the economy to make sure that we've got a strong understanding of what it means to be climate compatible for each of these sectors. And so essentially we're working sector by sector to bring that transparency and standardization across these benchmarks and green and climate criteria across all of these sectors. And then just to wrap up on the introductions, we then have a slide here which describes the certification process if you are looking to get your bond labelled as a climate bond. This is the process that you would need to follow to do that. Essentially, there's a step one, which is to prepare the bond, where the issuer does work internally to identify which of its assets are eligible to be included in a green bond based on their emissions performance or other metrics that will be set in the relevant sector criteria. And they would also prepare a document called a green bond framework. In order to prepare the information relevant for the certification process itself, they need to engage an independent verifier. The role of this verifier is to come in and check and give an independent view that the issuer and the assets they're nominating for their green bond do meet the requirements of the climate bond standard. And so an independent verifier can give us that view and writes a report, and that information is then submitted to the Climate Bonds Initiative and is reviewed by our board. And then if it is seen that the issuer is meeting the requirements of the climate bond standard, the board will then authorise that this bond can be certified, and then the issuer can use the climate mark and any other documentation when they take this bond to market, which is quite an important step. So it's basically then that the certification comes into its own. It provides a signal to the market that certain standards have been met, and those standards are very transparent. We make all the criteria readily available on our website and the background paper justifying them. And then the engagement goes on. The roadshow happens with the bond. Issuers invest in the bond. Once it's closed, we move on to step 4. There's a requirement for post-issuance certification, and that's where the independent verifier goes back in and just checks that the money has been allocated in the way that the issuer said it would be. So it's just a second stage check around the allocation and use of the proceeds have been in accordance with what was promised to investors up front. And then step 5 is annual reporting. That is quite light touch. You don't need to have the independent verifier involved for that. That's just the issuer provides annual report that you're still in compliance with the criteria, and it's almost reporting by exception if anything has changed with the bond or with the use of proceeds over the term of the bond. Okay, so that is it in the way of introduction about CBI and the climate bond standard and the work we're trying to do with the criteria. So now I'm very happy to hand over to Christine, who is going to talk you through some of the issues discussed and the objectives and the process that we went through in developing the criteria. So Christine, over to you.
Thanks very much. Hello, everyone, and thanks for your interest and for joining today. It's exciting to be at this stage of the process that began a little over a year ago. So just quickly, this first slide touches on a bit the mandate that was given in the development of the Marine Renewable Energy Sectoral Criteria that was just described very ably by Anna. And I think there's a couple key points here that are really important, that are really overlying, and all, I think the intention is that all the sectoral eligibility criteria are meant to align with this, so that there is, in each sector, which are going to be quite different from one another, that you develop a concept that lines up the eligible assets with global warming no more than 2 degrees C. So that is one of the challenges that can be non-trivial, and we certainly spend a fair bit of time trying to understand that in the early stages of the technical working group process. Another piece that actually was a new focus in 2016 to really do more of a deep dive with a focus on adaptation capacity and climate resilience of the bond-funded assets, focusing both on the asset itself and the surrounding environment. And I think the sectoral criteria across the board are increasingly going to reflect that mandate. The next point is that issuers and investors need to be able to see that the asset is truly climate compatible. In many cases, investors are not going to have the deep understanding of the renewable energy asset, so it's the job of these criteria to ensure that there is a true climate compatibility, and that was something that was an important point of discussion at many points. And then the transparency piece, of course, being very important, and doing that at the same time. Transparency often relates to data and monitoring, but also keeping in mind the low transaction cost for the issuer. That represents, again, one of the trade-offs that the working groups wrestled with in terms of developing criteria that are both feasible and usable, but also do their job in really demonstrating to the investor community that climate compatibility. Next slide, please, Katie. So what was the process? So as with all of the eligibility criteria for the different sectors that Anna talked about, there is a governance process, which is to convene a technical working group, as well as to convene an industry working group, and they each relate to the mandate points that I mentioned above. But they do it from a different point of view and with different composition. So we got started working on this in April 2016, and really the first 6 months were focused at looking at the marine sector overall, because this was the first time that CBI had turned its attention to dig into this issue, to really look at the overall marine set of assets and understand where climate compatibility overlay with the bond market, so not just what are all the things that are worth doing in the marine sector to achieve climate outcomes, but where does that line up with what bonds as a financial mechanism can do? And so there's a lot of discussion to understand that. That was a really important first piece that we had to look at, and we looked at the sector overall in that first phase of the work. So we did that through a series of working group calls and a lot of between call work where we did a lot of desk review, we reviewed a lot of different materials, and again, we always with this lens of thinking about what's going to be necessary in terms of disclosure, what are the benefits in terms of mitigation, and what do things look like in terms of adaptation and resilience of the assets. And as you can imagine, when we're talking about renewable energy or fisheries or coastal infrastructure, the issues are quite different. And so beginning in September last year, we began to think and operate a bit more in subsector mode, which is a little bit different than some of the other eligibility criteria, but started to make a lot of sense because we wanted to be able to focus in and be specific. We've also relied heavily on an industry working group to get feedback, to understand whether the technical criteria that as they were evolving really made sense from the point of view of verifiers, potential bond issuers, and potential investors. And now, having gone through that process, we're at this public consultation stage. Once we've had these webinars and had a 6-week public consultation, we'll take on board and integrate all of those inputs, and we'll work with the IWG and the TWG to revise and go to the Climate Bond Standard Board for final approval. And again, this will be the first of 4 different criteria within the marine space. Next slide, please. Just to give you a flavor of who's participated in this process over the last year and change, as you can see on the left, the technical working group. Each of these groups has about 20 members, and it represents experts that from development banks, environmental consultancies, academia, NGOs, and again, across all of those topical issue areas of energy, coastal resilience, fisheries, and aquaculture. The IWG consists of, again, as I mentioned, investors, issuers, verifiers, and again, their job is to look at it from that feasibility. Does this make sense? Is this something that has the potential to really be taken up by the market? Next slide, please. So just to give you a flavor, as you can imagine, we covered a lot of terrain, and there were many topics that we took up, explored, looked from multiple angles, and really tried to understand, you know, kind of what was there. As you can also imagine, there are many places, because marine renewable energy is an emerging area where there have been really solid work, and there's a lot of really useful information and experience, and some areas where that's very much emergent. So, you know, we've captured that in the background document that's available online if you want to dig a little deeper, and certainly we can talk a little bit more over the course of the Q&A of this webinar. So again, of course, we looked at what is the actual potential of renewable energy to contribute to this overall goal of the low carbon global economy. And that I think because of a number of factors, the sort of emergent and diverse nature of marine renewable energy, covering wind, solar, tidal, wave, current, temperature, salinity, so all these different potential energy generation technologies, because of the various levels of development and maturation of these technologies, the fact that these are diverse and emergent, there's a lot of pilot scale activity because of the geographic variability, that while we can't stick a number on the potential of any one energy technology, it's not clear at this stage which ones are going to be out in front in which places, that the criteria have been designed very much with the idea to accommodate the full range of emerging technologies. So it was very much not a picking winners and losers or cherry picking technologies and designing around those. It's very much designed to accommodate a really broad and changing and evolving arena. We looked at what are the embedded emissions that might be associated with installation and operation of any of these technologies. We spent a fair bit of time on that because we wanted to, as we figured out the mitigation component of the criteria, we wanted to understand if that was, if the installation and operation were meaningful in the magnitude, in terms of you know, to the extent that energy generation was providing a renewable source of energy that could potentially replace existing or needed energy sources, and was therefore seen as significant potential for net greenhouse gas emission reduction. Did we need to require issuers to quantify the emissions associated with installation operation? Through the various consultations that we had, it was determined that these are essentially immaterial in proportion to the energy generation. So it'd be useful to hear if folks have other thoughts on that, but I think after looking at that from multiple points of view, that was a kind of a core conclusion. One of the other things we talked a lot about is how do we reference industry best practice, because of course this is an approach that CBI has used, I think, very effectively in other sectors to say what's the, you know, where do we have existing best practice captured in codified standards of one type or another. That it does not yet exist in the renewable energy, marine renewable energy sector, as far as we understand in terms of a global point of view, and of course the criteria are designed very much to be globally applicable. There is emerging experience in terms of the way these technologies are regulated in different places, and we certainly did our best to look at those and incorporate those into the thinking. We looked at the extent to which adaptation and resilience were an important feature of the landscape as we designed these criteria. And there are a number of pieces, I'll mention a few, that are now currently part of the criteria, and if you've had a chance to review them, you will have noticed this. One is planning for climate change of the asset itself. So sea level rise, changes in ocean currents, temperatures, wind patterns, et cetera. So to the extent that, that there is the capacity to anticipate these changes, that there's kind of a reasonable sources of forecasting and other sources of information to understand how that affects the technical energy generation potential of the asset. Issuers are meant to document that and incorporate that into the materials that they present at the time where they're seeking certification. Another piece is planning for adaptation, capacity, and resilience. Some elements here include plans for maintenance of the asset, training, contingency plans for extreme events, planning for decommissioning of the facility, and so on. And then a theme that's been really quite important throughout, and there's been some solid work in different areas, is this concept of making sure to demonstrate minimal impact on ecosystems and biodiversity. Again, it's going to depend quite a lot on the type of technology and the context in which it's being deployed, but there is an expectation built into the criteria that issuers will attend to and demonstrate that there's minimal impact in this area. So I think I'll stop there. I have a feeling there'll be questions as we move along, but just to wanted to give you a flavor of some of the issues that we did spend quite a bit of time on and that have made their way into the criteria after discussion and debate with the IWG and the TWG. Anna, let me hand it back over to you.
Lovely, thanks, Christine. And so with all of that in mind, I'm just going to give a summary then of the criteria as they stand. It's pretty short. We've summarized it on 2 slides, but I would recommend, if you are interested in the full detail, there is a document online, which is the full criteria document. It's not hugely long, but it's got more detail than this. So please do have a look at that detailed document for the specifics of these criteria. And that will be most helpful for us as well. So in a sense, the 2 areas really in terms of understanding the criteria. One is the scope, and that's in terms of the assets and use of proceeds that are potentially eligible for certification under these criteria. And in summary, these cover, as Christine said, a wide range of possible renewable energy technologies, including offshore wind and solar, tidal facilities, including in-stream, lagoon and barrage, any wave facilities or ocean current, ocean thermal energy conversion, salinity-driven energy facilities, or any hybrids of the above as well. And interestingly, what we are looking to certify, what we would be very happy to certify, is those renewable energy facilities themselves, and also anything which is effectively essential supply chain activity. So that would include, for example, the manufacture of components like turbines, or dedicated transmission lines. The requirement on those supply chain type activities are that they need to be 100% dedicated to these kind of renewables. And then they are also in this potentially eligible pool of assets and proceeds. And yes, as Christine said, we very much made this broad in terms of technologies. We don't want to pick winners and losers. We're not sure yet which of these technologies will win out. We've tried to make these criteria, therefore, pretty future-proof. We always commit that we will look again at the criteria on a regular basis. We will see what's happening in the market. We will see what's happening with the latest science, and we can adjust them accordingly at that time. But we, as CBI, we don't want to influence the market in terms of this technology over that technology. So this is deliberately broad. It's also broad in the sense that I know some of these are quite well established, for example, offshore wind. Some of these other technologies are still relatively early days, and it's not like we're seeing a huge number of green bonds in some of these sectors, for example, thermal energy or salinity driven. Again, there was a lot of talk within the TWG about this, but because we feel like these types of assets are subject to the same kind of climate issues and climate concerns, we can include them in these criteria, even though we might not see many bonds yet. From a scientific point of view and from a robustness point of view of the criteria, it's appropriate for us to include them in these criteria at this time, hence the broad bucket that we have here. As well, if anybody is familiar with our existing standards, you might also note that we already have wind and solar criteria. They were more designed with onshore wind and solar in mind, and we did have a discussion with the TWG about whether we needed to have offshore wind and solar under the renewable energy criteria, it was determined that it was worthwhile to have them here, the offshore facilities, particularly because of the sensitivities around siting these in a marine environment. And as Christine says, now that we are considering adaptation and resilience issues, we wanted to make sure that any solar or wind facilities that are going into a marine environment are properly taking account of that fact, and hence it was appropriate to have offshore wind and solar in marine, and therefore our existing solar and wind criteria will remain for onshore facilities that are more limited in scope for obvious reasons. Other things to say about these criteria, I guess it's worth saying what's not included here. So I've mentioned already that we want to support supply chain activities, so component manufacture and distribution. What we haven't included here are installation vessels to get some of this equipment out to their sites. This is purely because it's a holding point, really. We will have criteria coming out separately, and we will look specifically about shipping vessels and criteria around shipping vessels. So we have decided to exclude those kind of shipping vessels for the moment from these criteria until we can do a deep dive on relevant criteria for shipping in another working group, and then we will add them in at a later date. So they're a temporary exclusion at the moment. Okay, so that's in terms of what is critical in terms of scope. And then when we actually look at the criteria which decide whether those assets and projects can be certified or not, there are three components to the criteria. And it's worth stating that all of these three components must be met in order for the bond to be certifiable. Starting with step 2 here, the mitigation component. Again, like Christine said, there was discussion within the working group about whether we needed to set some sort of emissions threshold for these kind of assets. It was decided that because essentially these assets are very low carbon, they will be replacing fossil fuel, which is very high carbon, and therefore we do want to include them, and we can do that in a relatively straightforward way. Over the lifetime of these assets, even taking into account any construction emissions or associated emissions to get them up and running, this is relatively low in the context of their whole impact over their whole life, given it's a low carbon technology, and therefore we can include them under the mitigation component, and it's essentially automatically a free pass on them, as long as there is not significant fossil fuel backup for them. So we allow for fossil fuel backup for things like restart capabilities or monitoring capabilities, but other than that, as long as they're renewable energy driven and they're producing renewable energy themselves, then they are eligible for certification, and they would meet the mitigation component of the criteria. In addition to the mitigation component, then, we have this adaptation and resilient component. And like Christine said, so this is where we're trying to address two things, really. One, is the asset itself resilient to climate change? And two, given it's in a marine environment, we want to make sure that it's not negatively impacting on other users of that marine space. So they could be fishing communities, it could be other renewable energy installations. And really what we've gone for here is a more process-driven approach. We want to make sure the issuer is considering its resilience impacts on itself and on others. So the criteria here are very much around, is the issuer taking steps to assess its climate resilience risks? Is it putting in place plans to address those? Is it implementing those plans? Is it doing regular monitoring and update of that whole climate risk assessment process? And if it is doing that, it will meet these criteria. The proof for that, in terms of the evidence that we would like to see, or we would like the verifiers to be looking for when they're assessing compliance with this part of the criteria, that will often come from documentation that we think issuers will already have, that will come from planning regulation processes, environmental impact assessments they're already doing. This was an interesting point of discussion with the industry working group about whether this is something that they would be able to comply with, whether they would have the necessary information available already or not. And it was very much felt that through those kind of planning processes, through the assessments they're doing already, most of this information would already exist. It's just a case of packaging it, pulling it out so the verifier can see that these steps have been gone through and these processes are being followed, and the issuer is aware and adapting to climate change itself and taking necessary steps where they are felt to be significant issues around climate risks and climate resilience. And then lastly, step 1 is a disclosure component. This is an interesting one. We have added this into the criteria because what we see very generally in the green bond market is there is often not very good transparency of information about use of proceeds, broadly speaking, across the market. And we want to use the certification as a means to improve disclosure and transparency to investors. And so this disclosure component lists a number of things that we would like the issuer to make publicly available, either in the bond documentation or elsewhere on the website. And this includes things like just project location and size, who the key stakeholders are, description of actual activities that are going to be financed with the bond proceeds, and some information about the estimated level of generation of energy, and avoided greenhouse gas emissions and estimated impact on that front. Like I say, this is purely for disclosure requirement and transparency. We did have an interesting discussion with the industry working group, and particularly with representatives on that group who come from corporates or operators of renewable energy, and the view from them was very much that actually this information is often publicly disclosed already. It shouldn't be a significant barrier. They approved of the fact that we did want to try and ensure there was greater transparency about this in the green bond market. So this didn't seem to be a barrier to them to getting certification. So that was a positive for us. And then, like I say, just to reiterate, an issuer would need to meet step 1, step 2, and step 3 in order to be eligible for certification. But in a nutshell, this is what the criteria actually are. So at this point, I would be very happy if we could open the floor to any questions that you might have about any of this work, about the criteria, about the process, about next steps, whatever you would like. So I'm going to hand back to Katie, who's going to be our Q&A master for this part of the session. But please, as she said, please do message us in the Q&A box or send an email if you do have any questions during or after the webinar. So Katie, over to you.
Thanks, Anna. Just a reminder to everyone that the Q&A box, the tab is up in the top right-hand corner of your screen, and if you click that, then a Q&A box should come up. We've had a few questions coming through already. So just to kick us off, Anna and Christine, why have these criteria been designed with the 3 components? Why are all 3 necessary?
Christine, would you like me to answer that one?
Yes, because I think that relates beyond just just this particular sectoral criteria.
Yeah, sure. Okay, it's a very good question, this one. Obviously, we are the Climate Bonds Initiative, and it's a climate bond standard. When we first started our work with the sectors where we already have criteria like solar, wind, geothermal, buildings and transport, we looked only at mitigation. So we looked only at the emissions profile and trying to set any appropriate emissions thresholds for certification. As we've continued with our work and rolled out to other sectors, the need to address adaptation and resilience has become more apparent, partly because of the nature of some of these sectors, and partly because of just the reality of the situation that there is going to be unavoidable climate change. So it really is critical for us to make sure that we are trying to move the dial in terms of adaptation and resilience as well, so that asset owners and investors are all aware of the need for, if we're really talking about climate compatibility, it's not just emissions, it's also adaptation and resilience. So in our water criteria that we released last autumn, that actually focused a lot more on resilience than it did on mitigation, for the very obvious reason that we're talking about water resources, and water security is going to be pretty critical, and hydrological conditions are going to be changing quite a lot in terms of droughts and floods and rainfall patterns, etc. So we have increasingly been rolling out adaptation and resilience criteria, and all of the criteria we're working on now, so the marine space, hydro, bioenergy, land use, we're looking at adaptation and resilience for all of those sectors at the same time alongside mitigation. I think this question is a good one because it also relates to another question that we often receive, is what's the difference between a climate bond and a green bond? It's a pretty fuzzy line, to be honest. We are the Climate Bonds Initiative and Climate Bond Standard because we wanted to give real emphasis to climate issues. We operate in a green bond market. And to be honest, most people that are issuing green bonds, many of the factors relate to climate-related issues, the mitigation, adaptation, resilience that I mentioned. They also include other factors. They might include pollution or waste management or water stress, etc. So there is a huge amount of overlap between what we're doing and the green bond market. And I actually often, possibly confusingly, use those terms interchangeably myself. I think it is interesting that we, in terms of our criteria, are trying as much as possible to focus and ensure we prioritise climate. But when we look at resilience, actually that, and land use is a good example here, that is one where we see this spectrum of what resilience means does incorporate a lot of these other factors that people will include under green anyway. So it's about the health of the land, soil quality, how we deal with waste, what we are doing with water resources, etc. So underneath resilience, we are capturing a lot of those factors that people consider as more broad sustainability or green issues. We're just taking a climate lens on that, which is often the kind of threat multiplier to all those kind of pre-existing issues anyway. And it's interesting as well because we are currently working on hydropower criteria. And given the sensitivities of that sector in particular, in that sector we are moving further into social criteria as well, just because of specific issues around resettlement there. So it's very much a kind of rolling programme of broadening out the types of things that we are looking to assess under the criteria that we can link back to the climate agenda and climate objectives.
I would just add to that, that was, I think, really, really useful, Anna, just to say that, you know, the green bonds market is new and growing quickly, as Anna described earlier on. And I think, as I understand it, there's a wide array of reasons that purchasers of labeled and certified bonds would be interested to do so. One of the motivations for some buyers is the idea that resilient assets where there is significant adaptation capacity may actually be at lower risk. So building the science around that in any given sector, in any given area is still emergent, but I think it is part of the overall picture. It's part of the storyline of why a green labeled bond is something that has market appeal. So I think that's another reason, kind of at the big picture level, for including that adaptation and resilience component, in addition to just the value of making sure that those issues are attended to properly.
Thanks. Right, next question. Many tidal in-stream device designs are also applicable to river environments. Are river locations considered in the Marine Renewable Energy Initiative of the Climate Bond?
Yep, I'll take that one as a first pass then. That is a really, really good question, and actually it's a good point for us. Maybe we should be clear about what we mean, because we often talk about sort of near shore or far shore, and I guess in a sense these river-related assets, particularly where we're talking about river flows or something like that, which are very like tidal at sea, would all be in scope for this. So yes, I think it's a very good question, and it is something we should clarify, that we're talking about these kind of technologies to provide renewable energy via water power, one way or the other, and therefore yes, they would be in scope as well, not just those in a pure marine environment. Yeah. Christine, have you got any additional thoughts on that?
No, other than it's a great example of, you know, because you mentioned there's a hydropower group, and, you know, that this approach that CBI has taken in building these sectoral eligibility criteria, there's a lot of very good reasons to do it that way. One of the challenges, of course, anytime you're doing things on a sectoral basis, is drawing boundaries, and those boundaries can be quite fuzzy at times. So I think that, you know, this represents one of many, many boundary points between different criteria, some of which exist already and some of which do not exist already. And I think that's just simply a feature of choosing to go with this particular approach. But I don't think that undercuts the approach. I think it's a feature of it, and there's no perfect way to do it.
Okay, next question. Could a components manufacturer use these criteria to issue a bond to raise finance?
Yeah, absolutely, and we would be very happy to see that sort of activity being certified. They're very much designed to cover a components manufacturer or a distributor, anybody who's involved in actually bringing renewable energy to fruition is potentially eligible under these criteria. And in a sense, what we're talking about there is if you have, let's say, a factory for manufacturing turbines or something like that, and as long as the components that you're manufacturing are dedicated to renewables, then you will be eligible for certification. We did have an interesting discussion on a similar note about platforms. And so platforms that are used offshore for wind turbines or something like that, whether a manufacturer of platforms will be able to be certified. And actually that is a very tricky one, because the same platform might also, or the same manufacturer might also supply through the same manufacturing facility platforms for oil and gas installations. And in that case, then they wouldn't meet the requirements for certification because they're not dedicated to renewable energy supply chains, so they wouldn't be. So it all comes down to this dedication point. So yes, we absolutely want to see component manufacturers being able to be certified and support that, as long as they're dedicated to renewable energy.
Thanks, Anna. And then a question more about the verification. Who's responsible for checking that an issuer complies with these proposed criteria?
Yeah, thank you for that one. That one is essentially, this comes back to the approved verifiers that the issuer would need to hire. And the Climate Bonds initiative, we basically maintain a pool of approved verifiers, and that includes people like the Big Four, PwC, Ernst & Young, Deloitte, KPMG, and it also includes a lot of the sustainability consultants like Sustainalytics, Oakham, DNV, Vigio. It also includes now a lot of verifiers who have very local specialist knowledge. So we're engaging with a lot of verifiers in China, for example. We've had one recently applying from Norway. We've got various around Europe, North and South America. And so what we're trying to do is we will vet verifiers before we approve them so that they can assess bonds and eligibility for certification. They submit information to us about their technical capability and their knowledge of the bond market, so whether they are credible entities to be doing verifications under the Climate Bond Standard. And our Climate Bond Standards Board actually reviews that and approves the verifiers. Once they're in the approved pool, we do engagement and training with them. We monitor the quality of the reports that they provide to us on behalf of issuers to make sure that the actual verification process is sound, that it's being done to a good standard, and we can trust the results of the assurance reports that the verifiers are given. Those assurance reports are critical to this process. Essentially, once the Climate Bond Standard have approved a set of criteria, and it's gone through the governance process for development that Christine described, and then it's been approved by the board, the verifiers are really key to this whole process. It's their independent view and the report that they give on the bonds and whether those bonds meet the criteria that is the key deciding feature about whether the bond will be certified or not. What the board is effectively doing is checking that that process is robust, that the verifiers are doing a good job, and that they have applied the rules correctly. So there is quite a strong governance and oversight program over the verifiers as well. And if anybody is interested, we do have available on our website the list of currently approved verifiers. I think it's about 35 now globally, and that shows in which jurisdictions they can operate and in which sectors they can operate, that they're being approved to do certifications for us. So that is all available on our website as well.
I would just add a comment to that, which is I think one of the things that's exciting about the Climate Bond Standard is that, this is very much an emerging space with a lot of growth, and I think a lot of these different pieces need to come into place. You need certification standards that are science-based and technically credible. You need interest in the market, you need issuers, and you need verifiers, and these are all changing rapidly. And so, I think looking at that taxonomy slide that Anna showed earlier of all these different sectors and subsectors, some of those are going to be quite robust in terms of the verification capacity, and some it's going to be more emergent. And so I think that's both what's exciting and what's a bit challenging, is that to develop criteria with so many different considerations in mind, one of which is to what extent are they feasible for entities who need to provide that independent verification function. So, you know, I think we've operated largely in a optimizing across many different needs and considerations in developing these criteria, and certainly hearing back from verifiers about the ways that the criteria are successful and useful for them is really important.
Thanks, Christine. And then on a related note, what evidence are we expecting issuers to give to prove compliance?
Yeah, great. Thank you, Katie. Yeah, this is interesting. Basically, in terms of the disclosure component, like I said, it's that you will meet those requirements if you've made that information publicly available, ideally in the bond documentation. And so that's what the verifier will be looking for, that information is readily available to the market. Under the mitigation component, because that component is relatively straightforward, it's basically that this asset does exist or it's in strong stages of development and there's clear evidence that it will exist and the proceeds will be used for that purpose. And it's not highly supported by fossil fuels. In a way, that's relatively easy for the verifier to check as well. The third component about the adaptation and resilience is where it gets a little bit more detailed. And like I said previously, the way that you would prove compliance with that is, we think in many jurisdictions that have quite strong regulatory processes, the existing documentation that an issuer would already have arising from those review and regulatory processes will probably provide nearly everything that the issuer would need to give to the verifier as its supporting evidence. So things like planning consent assessments, environmental impact assessments, planning control forms, whatever form those take in different jurisdictions. But we think they will, generally speaking, provide the evidence base that is needed alongside the kind of supporting documentation behind that, evidence of any kind of assessments that have been done behind that. It might become a little bit more difficult in jurisdictions where there aren't strong regulatory processes, and then it will be more of a bespoke pulling together of information by the issuer. You still need to meet the same requirements, but it might not be such a well-travelled path to doing that. So we would want the issuer to pull together still supporting evidence and documentation. I mean, hopefully they've already done an environmental impact assessment and similar assessments anyway, even if they weren't obliged to by the regulations. So the information should come from the same sources, but we are open to being more flexible about what the sources of information are there, as long as the verifier considers it to be credible and robust enough. That's the key factor for us in that assessment.
And just to add, you know, one of the trade-offs that for which there's no perfect answer that we've looked at both in the marine sector and in the land use sector as well, is that there is a trade-off if given the broad geographic range and potential application of marine renewable energy technology and the wide variation in regulatory contexts and processes, that even though there are some jurisdictions where there's probably some we could have required adherence to jurisdictional regulations that are basically credible and well regarded. But the unfortunate outcome of requiring that is you basically restrict issuance to those geographies. And there are good reasons why leaving room, even if it requires more effort and more documentation and possibly greater investment on the information and data side at the front end to demonstrate the compliance, the goal was to leave room for issuances and deployment of assets in all different kinds of geographies. So rather than basically sort of ghettoized issuance to places where the terrain is already well established, it seems that there's a real trade-off there. It's no perfect answer, but I think that's a bit of the logic behind why it's a little bit more open-ended when you look at the criteria table 3. It you know, that requires demonstration of proof and overall assessment for a variety of criteria. But the intention there is to leave room in many different places for deployment.
Thanks. And then a question about how can ship owners get involved in this?
Yep. In essence, we will be convening a separate working group that will look at shipping and ports. and so that will be subject to different criteria. For those, we would really want to be looking at for example, things like the fuel use of shipping vessels, and that's not something we've looked at under these marine renewable energy criteria. We're basically talking about different assets in the shipping sector, and that's why we will do it under a separate working group, so we can look more specifically about the climate impacts and the climate profile of those assets in the shipping and the port infrastructure space, and that will be done under a separate working group. Having said that, we never. Sorry, if I can say this clearly. The criteria are always focused around the assets themselves, not the company. So if, for example, a shipping company had renewable energy assets and it wanted to issue a green bond linked to those renewable energy assets, then these criteria would apply. If the shipping company wants to issue a green bond relating to their actual ships and their fleet, then they would need to use the forthcoming shipping criteria. So it's very much around the asset. And the reason that we've done that is, for example, in another sector, if we have a fossil fuel company and we don't certify fossil fuel activities, but if we have a fossil fuel company that's diversifying into renewable energy, either onshore or offshore, and it wants to raise a green bond for the renewable energy component, then that is something we would certify because the proceeds are linked to those specific renewable energy assets. And they would be subject to these requirements. So yeah, it's very much geared around the asset and not the company profile overall.
Thanks, Anna. And then a process question. What is the time frame for when the Marine Renewable Energy Criteria will be active in the market?
Yep, great. Basically, they will be out for public consultation for another few weeks. After that has gone through, any feedback that we have, we will take it into account with the TWG. We will revise and update the criteria as necessary, and then they will go to the Climate Bond Standard Board for approval. So we are looking at around about September, maybe October, and then these criteria, I think it's safe to say October, to get it through the Climate Bond Standard Board, prepare the documentation, and then they will be released into the market early autumn time. So we're on the final stretch, I think, here.
Yeah. Okay. And then a question about relooking at the criteria. So what happens if down the line some of the newer and unexplored fields actually have a bigger impact on ecosystems and biodiversity than originally thought when approved?
That's a great question and a great follow-up to some of the comments that were made earlier. So we very much talked about this, and that's the other side of the trade-off, that if you, for example, design these criteria in such a way that it restricts issuances, certification of marine renewable assets only in jurisdictions where there are already reasonably robust, credible, well-developed regulatory processes that accommodate concerns related to impact on ecosystems and biodiversity. So the one negative outcome is if we restricted only to those jurisdictions. There's a wide array of potential marine renewable assets that would not be able to receive certification just simply because of their geography. Another way, of course, we want to screen out we don't want assets to become certified. One of the ways we would ensure that is to say you meet jurisdictional requirements that are considered robust for these considerations. But the other way is to basically provide evidence, and there's a variety of ways that could happen. One would be to demonstrate that that the deployment in a jurisdiction where there aren't strong regulations, that the deployment itself actually meets basically the same standard as in a well-regulated jurisdiction. So that would be one type of proof that would make sense, I think, under this adaptation and resilience component and best industry practices component of the criteria. So I think that's basically how it's intended to work, is that even if there isn't jurisdictional coverage, basically, of these issues, that the criteria are meant to capture that, and sort of easier to complete and meet those criteria, meet that element of the sectoral criteria in a jurisdiction that's well regulated, it's just harder to do, and it probably is going to require more effort and more investment in documentation. Would be my answer to that. It's still not intended that if you're in a jurisdiction without good regulations that it's a free for all. That's not the design or intent of the criteria as they're designed. But certainly feedback on whether we've done that well enough is very welcome. Anna, any other thoughts on that?
Yeah, just to add to that, I think in terms of it's more of a process question as well. So when I outlined the process earlier and I talked about pre-issuance certification and post-issuance certification and annual reporting. So when it comes to the post-issuance certification, we do require people, even on the, and I talked about, one of the requirements of the post-issuance certification is ensuring that the funds have been allocated in the way that the issuer said they would be. Another part of it from the kind of green credibility side is we want people to ensure and continue to report that they still meet the criteria. If they don't meet the criteria, they need to report that to us, and that's clear in the criteria. There needs to be reporting by exception if something has significantly changed. And we do always have the ability to remove certification from a bond if it turns out a number of years down the line that the criteria are no longer being met. We haven't had to do that so far on any of the bonds that we have certified, but we do always have that mechanism if there are issues with the bond over the term of the bond or the term of the asset linked to the bond. So that is a mechanism that is available to us as well if there were serious issues with the green credentials of the bond over time.
Thanks very much, Anna and Christine. We have more questions coming in, but I'm afraid that's brought us to the end of the time available for this webinar. If you have further comments that occur to you after, then please do email them across and we can have more discussion over email. And we're very interested to hear them. But thank you very much for attending this webinar. And as I said at the beginning, we will be putting a recording up on YouTube, and I'll email that around. So if you're interested to listen again, or you know others that are interested, then please do listen to that. We're also going to be holding a second webinar for people that weren't able to make this one on next Wednesday at midday, and the registration link is on our website. So yeah, thanks again for attending, and thanks Anna and Christine for talking us through the criteria.
Great.
This is great.
Thank you, everybody.
Nice to hear the questions. Take care. Bye-bye.